Welcome to our in-depth tutorial on balance sheet analysis. A balance sheet is one of the primary financial statements used to assess the health of a business. It presents a snapshot of the company's financial position at a specific moment in time. A balance sheet comprises three main sections: assets, liabilities, and shareholders' equity. The formula that it follows is assets equals liabilities plus shareholders' equity. Let's break down these sections one by one. Assets are what the company owns. They are categorized into current and non-current assets. Current assets include cash, accounts receivable, and inventory. Non-current assets are long-term investments like property, plant, and equipment, PP&E. Liabilities represent what the company owes. Similar to assets, they can be further divided into current and long-term liabilities. Current liabilities are obligations the company needs to settle within a year, like accounts payable and short-term loans. Long-term liabilities include deferred tax liabilities and long-term debt. Shareholders' equity includes the capital invested by the shareholders and the cumulative retained earnings of the company. It represents the net assets of the company. Now that we understand the main components, let's look at an example balance sheet. Here is the balance sheet of XYZ Corporation as of December 31st, 2022. Assets: cash, $50,000. Accounts receivable, $75,000. Inventory, $20,000. Property, plant and equipment, $300,000. Total assets, $445,000. Liabilities: accounts payable, $60,000. Short-term loans, $40,000. Long-term debt, $150,000. Deferred tax liabilities, $25,000. Total liabilities, $275,000. Shareholders' equity: common stock, $100,000. Retained earnings, $70,000. Total shareholders' equity, $170,000. From the example above, we see that the balance sheet balances. Total assets equal total liabilities plus shareholders' equity, $445,000 equals $275,000 plus $170,000. Now let's analyze what these figures mean. A critical aspect of balance sheet analysis involves assessing liquidity, solvency, and leverage. Liquidity refers to the company's ability to meet its short-term obligations. We use ratios like current ratio and quick ratio for this purpose. Current ratio equals current assets / current liabilities. For XY Corp., current ratio equals $50,000 plus $75,000 plus $20,000 / $60,000 plus $40,000 equals 1.45. A ratio above 1 indicates good short-term financial health. Solvency is assessed using ratios like debt to equity. Debt to equity ratio equals total liabilities / shareholders' equity. For XY Corp., debt to equity ratio equals $275,000 / $170,000 equals 1.62. A lower ratio typically implies more financial stability. Leverage refers to the extent to which a company is using borrowed money. The financial leverage ratio is another useful metric. Financial leverage ratio equals total assets / shareholders' equity. For XY Corp., financial leverage ratio equals $445,000 / $170,000 equals 2.62. A healthy balance between these ratios is important for financial stability. Now let's move on to some common questions. Question: why is a balance sheet important? Answer: a balance sheet helps stakeholders understand the company's financial standing, efficiency, and risk. It's critical for making investment and lending decisions. Question: can a balance sheet be unbalanced? Answer: in principle, it shouldn't be. If it is, there might be an error in recording assets, liabilities, or shareholders' equity. Question: how often are balance sheets prepared? Answer: public companies prepare balance sheets as part of their quarterly and annual financial reporting. Private companies might do it less frequently. In conclusion, Understanding and analyzing a balance sheet is crucial for assessing the health and long-term viability of a company. Ratio analysis provides deeper insights and helps in comparing different companies. Thank you for watching this detailed tutorial on balance sheet analysis. Don't forget to like, comment, and subscribe for more finance tutorials.